Hi, this is Andy Hoffman, Marketing Director of Miles Franklin Precious Metals, in our 25th year in business. It's midday, Wednesday, November 26th, and the title of this week's audio blog is Front Running. Well, it's my last audio blog before Sunday's potentially earth-shattering Swiss referendum, which, even if it fails, has already sent shockwaves throughout the dying central banking regime. The dramatic Catalonian secession vote will one day be written of as a political and economic shot heard around the world. And similarly, the Swiss vote will be remembered so monetarily even before it occurs. Of course, if the evil Thomas Jordan does in fact lose his propaganda war against reality, it won't just be a shot heard around the world, but a nuclear blast. I'll get back to that in a second, as frankly, given how much has occurred in the past day alone, I'd like to give as much background as possible of what the world looked like just before the Swiss storm. At its utter peak dislocation with reality, at the precipice of the most dramatic, cataclysmic relocation in financial market history. Okay, let's start with pure economic fact. Again, I can't be more emphatic, per the title of an article last month, that this is 2008 with one temporary exception. The exception I referred to in the article is the power that be's ability to prop Western stock markets with unprecedented levels of money printing and market manipulation, both overtly and covertly, and conversely in suppressing precious metal prices with the same. Regarding equities, I have long written of how investors' purchasing power is just as likely to be lost by a hyperinflationary blow-off as a deflationary crash. And as of now, the former appears more likely. Don't believe me? Take a look at the Venezuelan and Argentinian stock markets, which have soared to record levels despite the all-out crash of their currencies. South Africa's another one for that matter. Frankly, I don't know if the US, Japanese, European, and even Chinese PPTs will be able to continue their equity lunacy much longer. But trust me, if they do, it will be at the expense of their currencies, yielding massive inflation, unrest, and significant expansion of the already white-hat global currency wars and economic recession. As for precious metals, as I watch a whopping 9% of the Shanghai Futures Exchange silver inventory withdrawn overnight, gold forward rates plunging to a new 15-year low of negative 0.34%, news of record Indian silver imports, and a new report from GFMS Mineral Services not only noting significant drawdowns of London silver inventory, but actually writing of peak global silver production, it couldn't be clearer we are headed for physical shortages the world may never recover from. Will this be the month it occurs? I don't know. But with COMEX's first delivery date looming Friday, with extremely elevated open interest, and the Swiss vote this weekend, who knows? Back to the economy itself. What more does one need to see than the catastrophic collapse in oil prices, which, given my nearly 20 years of oil industry experience, I don't believe OPEC has the slightest ability to reverse in its meeting tomorrow. Not that they really want to, as frankly, if I were them, I would absolutely engage the high-cost, heavily leveraged shale oil industry in a bloody price war. Saudi Arabia already gave indications of such 2 weeks ago, when it cut prices for U.S. exports while maintaining prices to other markets. Yesterday, in the traditional pre-OPEC meeting between Saudi Arabia, Venezuela, and non-OPEC producers Mexico and Russia, no production cuts were agreed upon, and despite the ensuing jawboning when prices plunged anew, Saudi this morning stood firm by its expectation of no production cuts. What would be the point anyway, as at this point, no one even believes that they'll do what they say. And given how rapidly global demand is plunging, it almost seems useless to try and gauge the correct production level. As I write, oil is in freefall, with WTI crude down to $73.50 a barrel, following an utterly abysmal spate of U.S. economic misses the past 2 days. Frankly, I believe a return to the 2008 lows of $40 per barrel is a very strong possibility, at which point the financial calamity experienced in the shale oil industry, which care of Wall Street is now the largest high-yield sector, will rival that of the mortgage industry in 2008. And if it does get there, global PPT operations, as well as the New York gold pool, if it still exists, will truly be put to the test. For that matter, What part of all-time low interest rates says anything other than catastrophic global collapse? Let alone Abenomics 2, European QE, and the Fed's purported considerable time before raising rates. Not to mention its own covert QE, given that the Dow Jones Propaganda average has now risen via dead ringer algorithm every single day since the supposed end of QE on October 27th. In other words, on all 20 days since the Dow surged at exactly 10 a.m. Eastern Standard Time, i.e., when the Fed's open market operations, which injected QE cash into the market like clockwork for the prior 22 months, supposedly terminated. But then again, the Fed is indeed far from all-powerful, as by all intents and purposes, its machinations have failed in every imaginable way. To start, never have so many currencies collapsed so rapidly, principally due to the exportation of inflation from the world's reserve currency issuer, and secondarily, the currency wars that prompt central banks to take the politically expedient but economically suicidal steps of debasing their currencies further under the comically flawed theory that it will bring more jobs. Next, care of the exploding, unsustainable debts caused by unfettered money printing. There is literally no chance of economic recovery until said debts are written off, either via default or hyperinflation. Trust me, it will happen, and at this point, it's difficult to gauge which method will dominate. However, looking at what Zero Hedge deems Europe's new scariest chart, depicting the surging popularity of pro-default political parties in Spain, Italy, and Greece, my guess is the former will occur in nations that cannot determine their own fate, followed by the latter in those with their own unfettered printing presses, like the US, the UK, and Japan. Back to interest rates, I again feel compelled to bring up perhaps the most important article I've written to date, which in many ways inspired today's audio blog title. That is May's most damning proof yet of QE failure, discussing how the Fed has no doubt been selling treasuries for the past few months, desperately trying to prevent the universal realization of U.S. economic collapse that plunging interest rates portend. In May's 2.6% enough said, I discussed how the Fed was clearly setting a covert line in the sand at 2.6% on the benchmark 10-year Treasury yield, which was decidedly broken in June and replaced in 10 basis point levels all the way down. Heck, last month I wrote that 2.3% is the new 2.6%, and following yesterday's horrific spate of economic data, all from the recovering United States, 2.3% was decidedly breached, sitting at 2.23% as I write Wednesday morning. Not to mention, just hours ago, the Bundesbank sold 10-year bunds at a record low yield of 0.74%, which is exactly where U.S. Treasury yields are headed, as the entire world front-runs Federal Reserve QE to infinity. And thus, when the talking heads speak of the expectations of the Fed raising rates in June 2015, i.e., 7 months from now, LOL, I can only blanch with incredulity as rates in the real world plummet to all-time lows. To that end, I know markets are no longer freely traded. However, if there's one thing I learned in my 25 years in the markets, it's when something spikes down as dramatically as Treasury yields did last month, when the 10-year yield touched 1.9%, they nearly always return to fill the gap. And speaking of front-running, now that several major German banks are paying negative yields on bank deposits, how long will it take before European and eventually Japanese and American investors pull their deposits and put them into the safety of zero-yielding gold and silver? Back to the aforementioned abysmal U.S. economic data, it has literally been across the board horrible. Aside, of course, from the comical 3Q GDP upward revision reported yesterday morning from 3.5% to 3.9%. John Williams of Shadow Stats deemed the report nonsense And based on the fact that real economic data, such as retail sales, industrial production, and factory orders, have been flatlining all year, it strains even the most creative, seasonally adjusted imagination how the U.S. government book hookers can even come up with such lies and do so with straight faces. Heck, even according to the published data, such GDP gains were entirely due to a combination of surging government defense spending, utilizing printed money, pushing the national debt to $18 trillion, and an $80 billion reduction of America's total personal savings, or more than 10% in one quarter. Throw in record subprime auto loans, not to mention subprime auto delinquencies, and unprecedented manufacturer channel stuffing, and it becomes quite clear that the manufacturing recovery is a sham. Heck, even the MSM's leading financial cheerleader, CNBC, who has probably lost more money for people than anyone in history, published a report yesterday titled Manufacturing Blues on the dying U.S. manufacturing outlook, as validated by this morning's abysmal sales outlook by John Deere, one of the world's largest construction equipment manufacturers. And as for the so-called profits boom, look no further than the ZERP-funded buyback of 11% of all U.S. stocks by companies that no longer invest in property, plant, and equipment, and some of history's most liberal accounting for your answer. And now for the litany of other U.S. economic data reported this week. Activity that occurred after the third quarter, which ended 2 months ago. And before I get started, let's just say the data gives new meaning to the term clean sweep. Okay, on Monday, following yet another OECD cut in global GDP estimates, and a global business confidence reading reported to have fallen all the way to the levels of the 2008 Lehman lows, we started the week with the Chicago Fed National Activity Index plunging from 0.47 to 0.14 against expectations of an increase to 0.5. Next up, one of the most upwardly rigged island of lies reports imaginable, i.e. the PMI Services Diffusion Index, fell from 57.3 to 56.3 versus an expected increase to 57.8. Then came Tuesday, when simultaneous with the aforementioned bad joke that was the 3Q GDP revision, the Case-Shiller Home Price Index 20-city average was unchanged, as was the FHFA Home Price Index, which was expected to have risen 0.4%. The hits kept coming with the Richmond Fed Manufacturing Index, which experienced its biggest monthly decline ever, from 20 to 4, compared to expectations of a modest drop to 16. Similarly, consumer confidence not only didn't rise from 94.5 last month to the expected 96.5, but instead plunged to 88.7. David Stockman wrote a brilliant article of a similar head fake last year when rising October confidence gave way to an utter collapse in November. And we all know how last year's holiday spending turned out at its lowest level since the post-crisis lows of 2009. By day's end, the aforementioned 2.3% line in the sand was decidedly broken, with the 10-year Treasury yield closing at 2.26%. However, the fun was just getting started, as this morning we started with the MBA's Purchase Application Index plunging by an astonishing 10% last week alone to a new 19-year low. Next, one of the remaining Island of Lies statistics, weekly jobless claims, exploded higher, printing at 313,000 versus 291,000 last week, compared to expectations of a decline to 286,000. Then we had personal income and spending numbers, both of which barely budge higher, both of which were well below expectations. And I'm just getting started, as not only were durable goods orders barely positive, but core durable goods orders, excluding cancelable and often military transportation orders, plunged a whopping 0.9% against expectations of a 0.5% increase. And how about this one in the Department of Massive Government Fraud? Not only did new home sales badly miss expectations, coming in at 457,000 versus 467,000 last month, and an expected increase to 470,000, but the last 5 months' data were revised dramatically downward, with May's initially reported sales of 504,000 reduced to 438,000, June's 419,000 to 409, July's 427 to 399, August's 504,000, which I railed against in vehement fashion when initially released, all the way down to 453,000, and September's 467,000 to 455,000. In other words, pure lies, which pretty much describes everything the U.S. government publishes regarding its dying economy. Then you have the number one island of lies report of all time, the so-called Chicago PMI diffusion index, which plunged from 66.2 to 60.8 versus expectations of a modest decline to just 63.2. And last but not least, the pending home sales index declined by 1.1% against expectations of a 0.6% increase. In other words, unmitigated, across-the-board misery amidst the world's supposedly best economy, which we're told has been recovering for a record 6 years. Frankly, the only thing more mind-boggling than the MSM's insistence that the U.S. economy is even expanding, let alone in strong fashion, is their utterly ridiculous explanation of rigged market movements. I'd say today's Yahoo Finance top story, in justifying the German stock market approaching its record high, can only be deemed a one-time anomaly of idiocy. But sadly, these are the type of things they write every day. To wit, their headline this morning is ECB Outlook Lifts Europe Shares, which would imply an improvement in the ECB's economic outlook. To the contrary, the copy reads, European shares pushed higher on Wednesday, bolstered by the prospect of more stimulus from the ECB, and as upbeat U.S. economic growth data calmed investor anxiety over a deteriorating global outlook. Really? Upbeat U.S. economic growth data? Did I miss something in the litany of horrible headlines above? Let alone a calming of investor anxieties, whilst nearly all Western markets are rocketing ahead, in the S&P 500's case, at an all-time high, shattering an 86-year-old record by trading above its 5-day moving average for an astonishing 27 days in a row? And last but not least, the principal reasons for stock rising, according to the MSM, is more money printing, which probably explains why, for some reason, gold has been maniacally capped at exactly the key round number of 1,200 per ounce all week on this COMEX expirations week, whilst both stocks and bonds rocket higher. Yeah, right. And finally, my last commentary before Sunday's historic Swiss referendum, which frankly, I cannot underestimate the importance of, whether yes or no, but particularly if a yes, of course. In this week's ECB and many others versus the SNB, I wrote of the massive tremors in the global financial system ahead of the Swiss vote, which no doubt are not just coincidences. First, ECB Governor Yves Marchais stating the ECB was considering buying gold, whilst Draghi gave his most dovish whatever-it-takes QE speech yet. Next, the out-of-left-field Dutch repatriation announcement of 122 tons of gold from the Federal Reserve. And just yesterday, an even more shocking statement from Marine Le Pen, who most likely will be France's next president. Yes, in the ultimate front-running exercise of all time, Le Pen issued a stern letter, which was very, very gold-savvy, meaning she had some significant banking firepower behind her, to the governor of Bank of France, demanding exactly what the Swiss yes contingent seeks, which is a full audit of French reserves, the end of all future French gold sales, repatriation of all French gold, and gold purchases amounting to 20% of monetary reserves. I mean, if the actions of the Swiss, Dutch, French, Germans, and oh yeah, the entire Western world, which is generating record gold and silver demand, don't discredit the barbarous relic propaganda, what does? To conclude, as Americans prepare to give thanks for their blessings, particularly the 1% that benefit from Federal Reserve money printing, and a few million Swiss prepare for the potentially most momentous vote in history, we can only say this. The entire internet-entwined financial world has become a giant front-running machine, particularly regarding QE-supported stocks and bonds, but to an extent all asset classes. Clearly, the massive record purchases of physical gold and silver in the Eastern world speak of the same. But as for the West, it has amazingly ignored reality through the rose-colored glasses of propped equity markets. However, as the global economy continues to worsen, gold and silver frontrunners will multiply dramatically, and in the event of a Swiss yes vote on Sunday, may well explode exponentially, potentially severely damaging and/or destroying the cartel permanently. Hopefully, you will be one of the few to get out the fiat exit door before the fire, and if you decide to do so, we hope you'll call Miles Franklin at 800-822-8080 and give us a chance to earn your business. And as always, I can be reached via email at ahoffman@milesfranklin.com. Have a great holiday, and to the Swiss people, we can only say this: do the right thing, which will not only save yourselves, but potentially billions worldwide. Thank you and have a great weekend.